just want to introduce myself. I'm Jeremy Arick. I'm a partner in our venture capital emerging growth group. We're all super excited to have you here. A little bit about Polsinelli. Well, nobody wants to hear about Polsinelli. If you have questions, feel free, swing by. This is what I do. I live startups. I breathe startups. It's happy to be an advisor, help out however I can, but you're not here to talk to me, so I'll pass it off to the people you actually want to listen to.
I'm turning this on. Is this working? Thumbs up? Okay. So we'll start off with intros. I'm Serene Pappenfuss. I'll be moderating today. I'm an investor at Kickstart Fund. We are an entirely Mountain West focused fund, so regionally focused first, and we do pre-seed and seed. It's primarily B2B SaaS and marketplaces, and that's what my background or career has been so far. Matt, you want to go next?
Yeah, Matt Blumstead, Springtime Ventures. We've got a partner in Atlanta, someone in Austin, and the rest of us are here in Colorado. We invest almost exclusively in healthcare, logistics, and fintech, pre-seed and seed stage.
My name's Matt Zweibel, so he'll be B and I'll be Z for the panel. I work with Drive Capital. We invest almost fully between the coasts. Very thematic investors, so I'd say broadly speaking, software, robotics, and then some early stage aerospace. My focus is early stage everything, but we're a multi-stage fund that'll do anything from first check in the door to pre-IPO check.
Cool. Hopefully this works. My name is Catherine Williams. I work for Dundee Venture Capital. We're a pre-seed and seed stage fund. We primarily do B2B SaaS in e-com, fintech, and supply chain, and we are from coast to coast investing.
Thank you. I love all the people on this panel so much. I'm excited for you guys to learn from my friends. So that you probably saw the panel title, which is Why Your Investor Said No. And the reason that we decided to do this is that I think a lot of panels, you'll hear a lot of panels focused on, how to refine your pitch, how to pitch more effectively. And a source of great frustration for many founders is why the heck did this investor say no to me? I don't really understand why they passed. This is common among founders who end up getting capital as well as those that don't. So we wanted to focus today on, that aspect of the pitch, in addition to how you can make your pitch stronger, digging into how you can get feedback more effectively. So trying to uncover those blind spots. And I guess the first question I'm going to pose to the group is, why are some of the reasons that you have said no to founders? Are there some common reasons that it tends to coalesce around? And what are some of the blind spots that founders should be aware of as they go into a fundraising process?
You want me to start?
Go ahead.
I'll take it. So for us, and some of this might be a little bit specific to how Springtime operates, but when you think about seed and pre-seed stage investing, you're really taking a bet on the people. So for us, anytime we actually pass, the real reason we're passing is either something related to the team or the market. It's almost never related to the product because the product is so early. We understand that there's a lot of work to be done there. I can kind of go down into a few bullet points, but usually it is either market size. We don't believe can offer a venture scale return. Market timing, just because you have the best product and you're actually solving a really deep problem. In some industries, it's really tough to sell into. And if there's not a buyer, then you don't have a business. On the team side, when you think about the industries we invest in, domain expertise is almost always very critical, and that kind of permeates through a lot of reasons we might pass. It could be the storytelling; they don't actually know their market that well, and some of that we can help advise on. And then there's also some edge cases where it's co-founder issue or issues between founders, and or in some rare cases like lack of integrity. We've uncovered some unfortunate things, but that's rare.
I would say that we're largely into those two buckets as well. Couple additions that I could throw out there. Again, if you're coming to an investor for the first check, right? Like, vision's really important. So team and market size has to be there. But I have to know that you have a vision for the business that you can grow into, right? And so that's something that even if we try to feed it to you, that's not something that's going to be your vision that when you are up at 2 o'clock in the morning trying to figure out the next step for the business, that you're thinking about what we wanted. No, it's really about what you wanted as a founder. And I would say if you're building a software company, which is what we invest in quite a bit, we really want to see a technical co-founder on the team. It's not like an immediate pass if not, but I would say many brownie points if so, because if you're working with like a dev shop that's external, you need to make a pivot in the business. Are you going to be first in line to make that pivot, or are you going to be third or fourth in line because they brought on some other clients as well? So just two things to add to what B said.
Go ahead, Catherine.
You don't want to say anything?
I do have a follow-up question, but I'll ask once you go.
Okay. I mean, I always say we're 99% team. That's a hard statement to make because we're saying no to 99% of founders, which means 99% of people we're saying no to. But I'll say, like, I've passed on deals that each of you have sent me, that each of you are betting on. So we disagree even in these seats on who a great founder is, and that's a really good thing. I think we all see superpowers differently. We all see markets differently. We all see problems differently. It's really hard to articulate well what your individual superpower is for what you are building and what you are doing that's different than every other company in the market. So that's typically what I'm looking for, but the disagreement isn't necessarily a bad thing. Our job is more often to say no than yes. So we're looking for the differences.
That's a great point, that we all see things differently. I guess a follow-up question, too, is some of these things, particularly team and market, a founder could understandably say, is that actually within my control? How can a founder think about what is within their control, particularly as it pertains to team and market? Or is it not?
The one thing I would say I see a lot of people do poorly or not be prepared on is metrics. And I will say in early stage, everything is made up, and I used to make up things when I was pitching. So I know that your metrics are probably going to be wrong if we look at the financial model 5 years from now. What I want you to do is be analytically oriented. Because when I make an investment, every 6 weeks, we're going to get on the phone and I'm going to ask, okay, how are you doing? What's working? What's not? What are your North Star metrics? Every single time, it's working to become more sophisticated about numbers, understand what investors are looking for that shows, hey, this is working. We understand go-to-market. We understand the customer pain point. And that's not natural to most people pitching, but that's something I see people really, really struggle with. And people that are really good at it tend to catch my attention. So that's something that I do think is absolutely in your control.
I guess the other mentality that I would toss out there, and this was something that I didn't quite understand until I started, I went into one of my first weeks on the job, and I was a little bit annoyed. We had just passed on the first deal that we had brought to the table, blah, 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 blah. And I was like, yeah, you know what? It is hard to find a needle in the haystack. And one of our partners turned to me, and he goes, stop looking for needles in the haystack and start looking for stacks of needles. And it's a really interesting thing to think about, right? Like, when was the last time you saw a stack of needles? Haven't. But like, what are all the needles that you're putting together as a founder to think through, what's your hot take on the industry? Are you tracking the right metrics and the right milestones? Do you have the right team? Do you have the right, like, there's a lot of different things that go into it. So sometimes just a visual analogy is helpful for me at least.
I'd even add the right team or right metrics. There's really no such thing, and that changes over time as you figure out new growth models for the business. But knowing and trying to build that stack is a very good image for that, is what are you looking at, and are you constantly refining it?
Oh, go ahead.
You asked what's in their control, right? So I think that, and sometimes I'll just pass on this, but the founder has to be able to tell the story very well and back up the vision that Matt Z talked about with a ton of data. The best founders we've ever backed, in fact, had a separate slide deck of like 120 to 150 slides, and they analyze every single aspect of their market. So you've got to be able to tell the story. If you can't tell us the story and sell us, then it's hard for me to believe that you can sell the customer very well.
Yeah, the thing I always say is that the founder that we bet on has to be the best salesperson in the company. They're selling investors, and you're betting that they can sell future investors. They're selling their customers, and then they're selling individuals that they need to convince to join their company. Because why in the world would someone take a really risky bet joining an early stage company? On metrics, which Catherine brought up, let's talk about metrics. Matt made a valid point, which is that pre-seed, it's really hard to do any kind of robust analysis on metrics since there isn't much historical data on the company's performance. But when we can look at metrics, particularly at the seed stage, what metrics are important? What should folks know about?
I'm not going to take all of them. I'm just going to list like one or two and then pass it on. So I felt like I said too much the first time. One of the things, so if you have a little bit of data or time between the time the company was founded, so like what I would call like a later seed stage deal versus early seed or pre-seed, I want to see capital efficiency. How much did they raise, and what have they accomplished with this? So are they just going to continue to have to raise money forever before they actually generate any revenue? That's a big one.
I'd probably lean a little bit on the earlier stage, and I have so many people come to me and say, oh, I don't have any metrics. We haven't sold anything yet. But every single company has metrics, whether it's visitors to your website through 30 days after you launched it. I have a founder who just announced our investment in their company, and they track the number of media impressions across all the different outlets, and they had 31 million media impressions. And then they're going to track the funnel on customers after that. And that they're not selling yet. So that they are tracking something. There's always something to track. That metric will change as they begin to sell, but there are really amazing metrics that you can look at. You just have to figure out, okay, what can I be measuring? What should I be measuring to show something is happening? I am growing, I am learning, I am going to customers, and they're hearing something and learning something.
And on the customer side of the table, I would also say, like, we encourage our founders, like, we'll write the first check into a company and just say, like, spend the first month or two just going straight after customer discovery. And in a month or two, you can tell me what the through line is. Like, tell me what the hair on fire problem is that you need to go build a product to go solve or pivot your company towards, right? Because at the end of the day, like, I think we have 60 different active market maps right now. And so, like, I'm not going to sit here and tell you, like, what's the one metric that you should all be tracking. Like, all of you are founders, you're all experts in the spaces that you're in, and there's something really, really important that you're trying to figure out about the industry or your customer. So go figure that out, and to Matt B's point, like, tell the story.
Yeah, and there's so many metrics. Like when you talk about KPIs, you can track. Some things are more important for different businesses than others, like you said. At the seed stage, it's hard to really know what your LTV is going to be in most cases, I think. You can maybe dial in customer acquisition cost a little bit better, but it is very deal dependent, to us at least, on what you're tracking.
The two metrics that are most important for me personally are revenue/revenue growth, and the second is retention, which probably becomes more important later stage and can depend on type of company. To Matt's point, for instance, with marketplaces, I take a lot of time diving into, okay, what's the retention on both sides of the marketplace? What does that actually imply about your product and its quality? And you could dive into, like, what does retention mean by logo, net revenue, gross revenue? But that becomes increasingly important with stage, which begs the next question, which is, even though all of us invest at the pre-seed and or seed stage, we all work with companies that hopefully graduate to the later stages, and so we know what metrics become important as well. Are there metrics that become increasingly important? And what, to this broader discussion of why the investor says no, what should folks know about in terms of how this discussion may change or evolve with stage?
I kind of want to use a real life example here because we invested in this company, and it's actually a Seattle company, a fintech company, and what they do is they're selling to CFOs to help alleviate the paid time off liability is on their books. And what happens is this company was able to take off like pretty quick, and the reason was because they get a big company signed up like Boeing or just name another big company. They go live, and there's this like influx of revenue. Like they recognize a ton of their LTV up front. that's great, and it still is looking great. But then we just had a follow-on decision, and you and I talk about this because you're really good at it. And it was a tough decision because they're doing everything right, but for this business specifically, it became clear what their like LTV was and how much it was costing to acquire customers, and I'm like, oh, like this is going to be really hard to get to like 20-50 million in revenue. And so we still put a little bit more money in to support them, but definitely tapered back quite a bit. So yeah, that's just one like an independent example of a company growing up and something we didn't realize early on at the seed stage that was very important.
I'm thinking of a couple ones, but one of the things that I would say is, are you totally dependent on advertising to build your business? That could be B2B or B2C. And again, there's nothing wrong with using advertising, but are there different levers that you can pull for growth? That's one of the things that we've actually passed on a handful of sort of pre-seed to seed stage companies. Because if your CAC gets wild, and even if we flag it and try to get you to take a different perspective on it, if it's really difficult to turn that around, or you can't figure out another mechanism to do some organic growth, it's going to be hard to wrangle that long term because you're kind of at the whims of the tech giants that are out there. So I always try to encourage my founders to think about sort of, either referral-based or organic. Like there's a ton of different ways that you can grow without spending money on ads, but just thinking through what that could look like for you and your business is something that we've actually passed on previous companies for.
I feel like I'm going to put a bookmark in follow-on funding. That's always a really interesting discussion, is whether or not, as investors, we choose to invest again or not. And every team does it differently. So if, Serene, you want to talk about it, we can talk about it. Later stage, I previously invested later stage at Series B and up, and everything is metrics. So I say I went from investing based on numbers and spreadsheets to making up numbers and spreadsheets. So I think you have to be totally on top of what you're doing, how to profitably grow, how to profitably grow at venture scale is a different ballgame. How are we going to 2x the business, 3x the business over the course of the next 2 to 3 years and continue to do that? That's a hard thing to do, and you can build that playbook, and that's what you have to be doing at the seed and Series A, is proving out, okay, if I throw $2 at this, how do I turn it into 10? And how do I show that I can continue to do that over and over and over again? It's tough to do, but that is ultimately what we're trying to teach all of our founders how to do, and they have to prove that in order to be able to raise the later dollars.
100%. Yeah, Catherine and I both did growth stage investing in businesses over like 10 million plus, right? So yeah, we're both biased by that. Is it okay if we save Q&A for the very end? Oh, okay. Yeah, ask your question.
To Matt, I'm really curious how the conversation went with the company where you effectively said, we don't believe they're going to make it, but we're willing to like keep some money in it.
Yeah, it wasn't that. I should have chosen my words differently. So it's not that I don't think they're going to make it, because I think there's a lot of natural acquirers for this business. If I'm being honest with you, I did say, I have a hard time seeing this get to those revenue levels, and he understood it. It was just we were very transparent. He understood it, and he didn't disagree, because I wanted to clarify. We went pretty deep in the weeds on that LTV and when they're recognizing a lot of their revenue, and I told him this is why we're going to write this size of check. I think that they can still grow. Growth is just going to slow and taper.
So I'm going to ask a question. We're going to keep the company anonymous, but Matt, had you known that this company would probably just plateau at max, I don't know, like let's make up a number, 20 million in ARR or whatever, would you have invested in the first place? Like, let's say this company could grow predictably 20% year over year, up until a certain time, right? Would you have invested? Why, yes or no? Sorry, I'm asking you kind of a hard-leading question.
And it is because I didn't lead this deal on the team. We make decisions together, and so I wouldn't throw them under the bus. I just can take the blame for it and say that I didn't do enough work on the up front personally to. It's hard for me to look back. At that time, we all grow too as investors, right? Like the way I see things today is very different than the way I see things 5 years ago, and I hope that that's a good thing. So I'm not. That's a really, really hard question to answer, because I don't think it was that clear. If I had known what I know now, maybe the answer is no. We don't do it because we're looking for companies that can get to 50 to 100 million without having like a challenge like that.
And which is actually like, I know I was fishing for an answer, which is probably very wrong of me, but to us, it's I think obvious why we look for businesses that can get to 100 million ARR. But why is that so important? I think it actually is important to discuss that. Like, why do we have to find businesses that can achieve that kind of attainment?
Yeah. So we're looking for like really crazy outliers, and when you look at multiples and exits and factor in dilution over time from when you invest at the seed stage and what you might own when you actually exit, really that $1 billion number is usually pretty spot on. If you get in at 10 million or below at your valuation when you enter. And you got to think about it. Look at multiples on the public markets, what those are, and so if you can get to 100 million in revenue, you're probably a $1 billion company. If you can get to a lot more than that, then you're definitely going to be one.
Go ahead, Catherine. I'll make a point after.
I was going to say it's more of a math thing. So if we invest and buy 10% of a business and across a portfolio of, I don't know how many companies you have in your portfolio, 30? You buy 10% of a business, you have no idea. They're pre-revenue, it's an idea on a piece of paper. You have no idea if it's going to work out. 75% of your portfolio is going to fail in a couple of years, 5 years, 10 years. Some of those are going to succeed. 1 or 2 are going to become billion-dollar businesses. The 1 or 2 end up returning the entire fund, and the rest don't necessarily impact our financial returns. And it's weird. That's venture math. It's just funky. It's a very cool business model because we get to start 30 businesses with people. We get to help people start all 30 of them, and some of them won't work out. And in the, your experience of saying, we're not going to double down, it's not that they didn't make it. I think it's really hard to define that word. They did make it. They sold. They got to,
It's hard to tell. We've seen founders make $10, $20 million. It didn't really impact our returns that greatly, but damn, I'm really happy for them.
Well, their outcome is amazing. Ours is not based on that business, but we build a portfolio looking for 1 that will return the whole fund, 2, 3 that will return the whole fund, and then the other founders build whatever level they get to. Ultimately, we need to focus our time and resources on the outliers. But it's a tough conversation. It's something I think all investors have to have with the founders they back early on. We have this conversation and tell founders, don't take our check if you want us to be super nice and continue to back you in every round, because we can't and we won't. It's just not part of the math of the fund.
I think that was a great explanation by both of them. The trend that's been occurring, particularly over the last, 4 or 5 years, especially, venture capital is a relatively new industry. And what's been happening over the last several years is that funds keep getting bigger, and funds are getting celebrated for getting enormous, right? But what happens when a fund gets bigger is that there is even more pressure for every check that a venture capitalist writes. There's even more pressure for that single check to return the entire fund. So for reference, Kickstarter is investing out of a $220 million fund. When we write a check for $1 million into a company, we're expecting that, you do the fund economics, the math to Catherine's point, and we're like, hey, you are now on the hamster wheel. And that is a potential drawback of raising venture capital, is that you have to be really honest with yourself of, is this a journey that I want to take over the next several years to try to grow a $1 billion business in terms of valuation? If that's not something that you feel like you can grow into or that can be accomplished, venture capital probably isn't the right source of capital to raise. And there are multiple sources of capital. It's just venture capital may not be the right one. And the flavors definitely do differ depending on if it's true venture capital versus growth equity, since the expectations in terms of returns are completely different. But know that at venture capital, that is a very important thing. And I think it actually ties back to Matt's point at the very beginning. He said it ties back to team and market. When I think about market, that's actually, the math that I'm backing into. But let's go back to the discussion since we talked quite a bit about team. Is there anything else that you guys want to touch on market? Like, what does it actually mean to say no to a founder based on market? What does that mean?
Give an example. So you'll find that I like to do that a lot. So my second week on the job, I'm sitting with one of our GPs. He invites me into a meeting. and we're talking with this company. They're doing SOC 2 compliance. Things are going really well. ACV is about 20K. And again, I've always been on sort of like the founder and startup support side of the business. I've never actually really dove into the math. So this GP starts sort of hammering this founder on like, okay, well, if you can do SOC 2 compliance today, can you do HIPAA? Can you do this? Can you do this? Can you do this? And I'm sitting there and I'm kind of confused. I'm like, this guy's got like 300 or 400 customers. They're all paying good money. Like, I don't really understand why. And so afterwards I asked, and he said, oh, it's really simple. He goes, what's the math on getting to 100 million or $1 billion in revenue at 20K per customer? And if you can 5x that, then you can divide the number of customers by 5 and thereby get to the return profile that we're looking for as a fund the size of Drives, right? And it started to click to me that, like, I tell people almost every day, don't take our money, right? Because there's a pathway that you get on that you really have to build a huge business, and you have to keep your head down and not look up for 7 to 10 years until you get there. So it's just, it's a perspective from the founder side that I think is kind of interesting that I didn't quite fully understand a year ago when I started this game. And so now every time I sit down with a pre-seed founder, I say, listen, I'm not going to hold you to this, but like work me backwards from $1 billion in revenue. And I know you might have just gotten your first customer. You might not have $1 in revenue, but like I'm just curious to hear your thinking. I want to understand how you view taking venture money and how we're going to get to the same conclusion at the end.
Any other thoughts on market? I can see Catherine's mind going.
The wheels spin mostly because I see it at different stages, right? I think market gets more important as you go down the venture path. Market's really important at the beginning, but I can give examples of funds. All funds are different, have different priorities. There are funds I deeply admire who say, we want you to start in a small market and have 100% of it. There's a fund called Altos Ventures that's incredibly successful, incredible returns. They want folks to start and absolutely dominate one market and then move from SOC to HIPAA to other areas. But they want them to totally own 100% of a very small market and move from there. It just kind of depends on what your perspective is on market. I like big markets, but I recognize that they are all made up. And you don't really know what you're doing half the time. Our companies completely change the product that they're building. They might totally change industries. And so for me, at the pre-seed, pre-revenue, very early stage, I'm looking at a founder. I really like when they have an advantage in a large existing market. I think that's a really nice superpower to have if you can articulate that. But that's not always something that I'm looking for. So I'm 99% team, but that's not the only correct way to look at venture.
It's a great point on philosophies, completely differing. They're two great lectures, and I see them as very different in terms of the approach on, like, to your point, grab 100% market share of a very specific small market and then grow from there versus just capture a bunch of things all at the same time. On one hand, Peter Thiel gave a really fantastic lecture to Stanford where he does argues for the former, whereas Conrad, the CEO/founder of Rippling, argues for the latter, and that's actually worked really well for Rippling for them. So anyway, both videos are worth watching, but again, different investors and different founders will experience them in different ways, and there's not a right or wrong way. But it goes back to the point that Catherine made that different investors prefer different flavors, and that's actually a really great thing. A lot of different businesses, great businesses, have been produced both ways. So pivoting the discussion a bit, we've talked about why we may arrive at a no, and it may be really infuriating as a founder to not really understand all of the reasons why you were told no. What are some effective ways that a founder has gotten feedback from you in the past? Is there a good way with you guys personally?
Do you mean like mode or the medium or just in general?
Just in general, yeah.
We always try to really be honest 99% of the time. I say the only time I would maybe not give a full like transparent answer is if we just really got rubbed the wrong way and didn't like the person. It's not worth the time to get into a confrontation about it, frankly. But we try, sometimes I'll just give verbatim, like copy paste feedback from people in our network that, have given us feedback and why we're holding off and say, hey, a lot of times it's not always a hard no at this stage. It's like, I've got a lot of really deep questions, but if you can do these things, then we can outline those, and love to stay in touch. If sometimes it's a hard no, we'll tell them that too, and just tell them why. So I always, as far as like how we communicate it, it depends to me on how close like I felt to the founder. If we asked for multiple meetings, I will tend to try to do that over the phone or on Zoom in person. If it's just like a meeting or we didn't ask for too much of their time, and email, mostly will suffice, and for me at least.
Mode of feedback is hard. Everyone kind of has a different perspective on how they want to give feedback. I agree, Matt. I try to call people as much as possible to say no, just because it gives folks a chance to ask questions, versus on email can feel really impersonal. I think as a founder, what's in your control is when you have an investor on the phone, and it is really, 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 really hard to move from pitch mode to learning mode. And that's something that you have to master over time. But you don't need to pitch for any more than 10 minutes on any 30-minute phone call. If you can't pitch your company in less than 10 minutes and cover what you're doing better than anybody else and what's different, your pitch isn't ready. The rest of the phone call, you want the investor to ask questions. And if they're really quiet and not asking questions, throw out some things and pose them as questions and see if they dig in. Your best source of feedback is, where is the investor asking a question? Is what I said coming across correctly? Are they asking questions on market, or is our team full? Where are they digging in? You're going to learn so much from that. Copy, paste, repeat across all the investors that you meet with. You're going to get feedback regardless of whether you ask for it or not, because we all get interested in something. And so when I'm working with founders that I've invested in, I always ask them after they've done their first kind of round of investment or investor calls, what do people ask about? What were they interested in? What kind of was something that multiple people said, oh, that's really cool? Because usually you'll see it if you're on a Zoom call, you'll hear it in the way they ask a question. So I'd say moving from pitch mode to learning, it's a two-way street with investors, and I think a lot of founders forget that. You can learn as much from them, and they are absolutely learning from you. So make sure it's a conversation and you're learning from the process and not just trying to sell throughout the call.
I would say the other thing that we really try to find in every founder that we invest in is curiosity. So if we're gonna sit there and take 30 minutes, an hour to sit down and have a conversation, even if we're a pass, I love founders that come back to me and say, hey, I noticed that insert blank investor or insert blank potential customers in your network. Like, would you feel comfortable making an introduction? Like, I like when there's feedback that, it's not necessarily feedback, but there's like an ask that's actionable, right? That's number one. Number two, I actually just got the best email on Sunday. This company that I told like maybe 10 or 15 minutes after their pitch, like, it's not a fit. You guys are awesome. You don't need venture money, especially given your vision and what you're trying to do. I would look into crowdfunding. I totally forgot about this company, and 3 months later, they sent me an email. They were like, we crushed our day one crowdfunding goal. We had no idea what we were stepping into, but like, had you not taken the time to give that feedback, like, we would not be in this position. It totally aligns with the business, so on and so forth. So I just appreciated that, because kind of to Matt's point earlier, like, first meeting is everything. And so we're going to assume that the way that you approach us is the same way that you're going to approach your first customer. So it's something that we learn from. It's something that we really love to see, a really engaged founder. So there's a lot of little tidbits, but I would say just treat people how you want to be treated. And like, we pass on 99% of the companies that we see. It sucks. It's hard. Like, they're great people that I have to say no to every single day, but if that's understood from the beginning and that it's a business transaction, that it's not personal, there's a lot more that can come from that. So,
I love the point on curiosity. I think the thing I would say in tandem with that is just being gracious on both sides. The thing to keep in mind too is that VCs are mostly wrong. Like we're betting on one working in the fund, right? It's great if we could find 2 to 3, but we're mostly wrong. So keep that in mind. Brief story time. There was a founder who came to pitch Kickstart, and we said no. And Brandon, he came back and said, "Hey, do you have any feedback for me?" And it's amazing how few founders actually come back saying, hey, do you have feedback for me, without being overbearing. And I was like, yeah. So we gave him feedback, and that was at the pre-seed. He ended up totally proving us wrong, and we ended up leading a seed. And because we kept that really good relationship in between, we ended up being even more convicted on him and what he was building. And a little, like, the cherry on top is that I actually worked on the follow-on decision for his Series B a few months ago, and he continues to crush it. So the other thing to keep in mind, the gist of the story, is that a no may not be a no forever, right? You probe with the investor on whether it really is a no forever, if it's just simply not a fit because you're not a healthcare, logistics, or fintech company, right? Because some investors are going to be much more focused on certain themes versus you're just not a fit right now. Kind of flipping, are there any red flags that folks should be aware of? Like for me, just to give an example, burn is a huge one right now. If a founder comes to pitch and I'm like, okay, what's your net monthly burn? And they give a number that just seems insane versus their stage. For me, I'm like, I'm 99% sure it's going to be a no. Is there anything else that founders should keep in mind?
The first thing I open in a data room is a cap table. So just thoughtfully structure that. I think a lot of early stage success depends on how the co-founders work together and who is in the room influencing decisions. If you have taken checks from 500 individual investors before you've met me, that's 500 voices in your ear chirping and telling you things that maybe are not helpful when trying to drive a company forward. So yeah, cap table's my.
Can you
That's timely.
describe?
We just went, well, I love that you said that, because, gosh, we should give anyone this advice, but please, please be cautious of who gets on that cap table from day one.
Like, for you, is it who is on it, or is it ownership percentage? Like, what matters to both of you?
It was this recent example, and I'm going to tell you, so we're about to close a deal that it took almost 18 months. There was some pauses in there, but there was like almost 500 people on this cap table. And I'm not kidding you, I never would have taken on this work personally. He was kind of lucky that my partner, Rich, had such a passion for the business. We all supported the investment in the business and the founder, but I would not have, I just didn't have the patience to deal with it. Rich did, credit to him. But we just passed on another one for that reason. We literally can't handhold and fix this like more than once a year or once every couple of years. It's a lot of work, and it costs a lot of money, legal-wise, to go fix mistakes like that. So
I'd talk on the other side of it, not necessarily selling shares, but the common shares. How you divide between founders and early employees matters really, really deeply in terms of incentives. Are people going to want to stay, and is the exit outcome high enough if you succeed in whatever you're building that your two most important developers on the team are not going to hop and run to Google 6 months from now? So I look at the cap table as a way to understand how a founder is thinking about how they're taking care of equity and ownership in the company. That's really important because I'm going to have equity and ownership in the company. So do they care deeply about their own shares, but also what it means for their co-founders, for their employees, that they want to stick around for a really long time? It helps me to know how much they actually like their employees, because sometimes people give away 0.1% on day one, and I'll sit there and go, they're never going to stay. That's not enough to incentivize someone you really think is important. So I just think being really thoughtful around incentives, and it can look different for different companies, and co-founder split, it looks different for different companies, but have thought behind it, because that's the first thing that I look at and ask questions about. And sometimes the answer is really interesting, but.
So some of that can be tough unless someone benchmarks, right? That like a VP of sales should own X% of a company or have this much money at work. Are there other heuristics that you look for in terms of a founder should definitely own at least this much, or like what specifics should people know as they start on day one?
Carta has some good statistics out there on kind of co-founder splits and early employees dating from, incorporation of the company through later stage. That's a little bit biased. I always flag this for Carta just because Carta isn't a very expensive platform. So typically it's venture-backed companies that are on Carta. But at least in terms of what investors are looking for, those are good things to look at. The one that I will always bring up with teams is if you have two co-founders and split it 50-50. Who is making the decision in the final call? That can get messy. The other thing I think is really important is vesting, which I'm sure we all do, but making sure co-founders, anyone who has common shares, is vesting over a 4-year period is really important so that you're around to build the business.
Love it. That's really helpful. Matt, anything else from you?
I mean, the first is, we invest in sometimes founders before they're founders. So like, don't send me a blanket email. Like, don't look up my LinkedIn, look up Drive, find a portfolio company that aligns with something related to what you're building. Again, it's the same thing as the sales analogy. Like, I'm just going to assume that like you're not going to take the time with your first 10 customers, right? So that's number one. And the second thing is ask for help, right? Like, if we're going to invest in your company and you want to shoulder the load totally by yourself and just assume that there aren't folks around you that can help you with either customer introductions, a founder issue, product issues, hiring, you name it, like, that's part of what our job is. Like, we have a vested interest in making sure that your business is successful because our LPs want that, and so do we. So help us help you. And, I set up a weekly call with my founders, right? And is that sustainable? I don't know. But, like, it's one of those things that I think helps in the early days just to make sure that, we're creating trust and that there's something that we're both working towards. So ask for help. And even if you don't have investors, like, ask your community for help, right? Like, you've got a room full of folks that are going to experience something similar to what you're going to experience tomorrow and in a month from now and in a year from now. So, like, don't be afraid to go network and ask your community for support as well.
One note on that, don't give away 20% of your company to advisors.
Oh, actually, I just talked with a company about this. It's totally cool if you want to bring advisors on, right? Give them, I don't know, quarter of a point, something in that realm, like not a ton. But it's also okay to ask your advisors to drop in $5,000, right? Like, it's not necessarily saying that they have to come in and be like a full-blown owner and write a $100K check. But like, it's also not the worst idea for them to have some skin in the game and that they're not just getting free equity and they can run away.
Do you have thoughts on that, Matt?
I disagree with everything.
No, it's so true. There was one founder that I sit on the board of their company where we had to particularly coach them around how and when you give away equity of your company. When you do, whether it's an angel investor or an advisor, anyone else, just being so rigid on how you think about, okay, what does this person actually bring to the table? And how do I ensure that they have skin in the game, to use Matt's words? It is amazing how many angel investors and advisors don't actually, I don't know if care is the right word, but that you are not their full-time job. So it's very unlikely that you're actually going to get meaningful hours from them. So how can you set expectations up front? How can you get them to actually invest in your business with actual dollars to help ensure that they have skin in the game? It's a really tough dilemma, but don't underestimate that being an issue in the early days. The one other thing that I've been taking away from this discussion and my career in venture so far is that venture is a very long-term game. I think that's as much true for us as it is for you guys as founders. And to that point, we talked about how a no may not be a no forever. How can folks better ensure that they keep a relationship with a VC? How can they more effectively come back, knowing that they may have another shot pitching Catherine and getting Dundee to invest down the road, or name the investor, fund, etc.
Send us updates. Yeah, I mean, we've done that. In fact, we did one with you. I think Pomp was one where we passed 12, 18 months later, we ended up investing. And this has happened multiple times. That's just one example. But I don't think I've ever unsubscribed from somebody's updates that we've passed on, to be honest. Maybe I should, but at this point, but I do read them. I read every single, anybody that puts me on there in investor updates and sends it to me, I will read. So, and usually, and if there's an ask in there that I could help with, I will respond. And, when timing's right, it's really, really easy to pick back up because you can clearly see the progress they've made or not made. So,
yeah, I would say companies, like we just had this, a company came back to me 8 months later and said, here was every piece of feedback that you gave me 8 months ago and you passed, and here's how we've addressed that. Unfortunately, we still passed again. But the truth is that it was one of those really cool moments. And again, I'm early in my investing career, right? So it's like I'm a year in, and somebody took the time to actually take note of what myself and my team said, and went out to go address that in their business, and actually had some meaningful revenue, and it was actually really growing a business. It just was not a market that we were ever going to invest in. But I was actually really impressed by that. So, is that something that you can do for every investor? Probably not, but if that's something that you want to keep track of and maybe figure some way in your CRM to do that, that could be kind of interesting. So,
I think venture is one of those weird industries that we are absolutely incentivized to think in 10-year cycles, which our funds are literally structured on 10 to 12-year cycles. So I tend to think whenever I'm interacting with someone, am I going to be embarrassed 12 years from now? If someone comes back to me and sends me this email or this piece of feedback, am I going to be disappointed in what I said? Should I have given it more time? I think that's a good framework to have. And whoever you are, whoever you're interacting with, it's really, really hard in an environment where you need cash tomorrow. If you're a founder and you have to raise in this period of time, that's a tough thing to do, to be thinking on that time horizon, but we are. And so I think that's probably the best thing that I can encourage you to do, whether it's coming back 8 months later. I would have invested in that. But I just think most people would not do that. So that's super impressive. But yeah.
I love it. We share deals quite a bit, so know that you can always get introduced to your next person, even if someone does say no. I'll make this the last question, unless you guys have burning thoughts, and we'll open up to Q&A. I love the point that Matt just made of that he told the founder we need to see these 8 or so things, and they hit those things, but you still said no. Sometimes, I have a bias to see folks start to monetize by the time that they raise from us, because I want to see is there actually some semblance of product market fit? Is someone in the market willing to pay for this product? And so sometimes I give feedback to founders saying the traction's too early, and the founder understandably says, okay, but so what do I need? What do I need to hit? What are the bars? What should I know so that if I hit those, you will rate, or you will give me money the next time? And that's a really tough thing to answer, partly because we may not actually invest, and it may be for other exogenous reasons. I want to have a brief conversation on why is it hard to answer, and do you ever give folks a very specific answer, like, yeah, you're going to need to hit X, 100K in revenue, you're going to need to hit this much in retention, et cetera. For me, it's really hard to answer. Does that make sense?
It's extremely hard to answer. And sometimes things just change. Like a year later, we might have done more work on that market and not liked it anymore, or not had as much interest. Sometimes it's just like a partner interest too. That's why what makes it so hard, and why I will never give anybody a arbitrary number of, oh, you need this revenue. At the end of the day, like someone just last week I caught up with this founder, and he kind of came to us at idea stage. He has lined up 2 pilots, which is great. I'm happy for him, but I still don't. There's no product market fit there yet, and I haven't seen nobody paying for it, and so definitely want to see that. That's usually when we pass. That is a big reason, because we're unsure if someone's going to buy it, and some having some revenue, and being able to talk to customers that are actually using it and see the engagement and usage is really, really helpful. But I hate to say it, but I've been guilty of this multiple times over the years, where somebody comes back and it just, for whatever reason, it's kind of fund shifts focus on subsectors within the industries we're investing in that we're focused on, and just don't have as much personal interest in it. It's tough. We're just humans at the end of the day, and like she said, we're wrong a lot. We screw up.
Yeah, I think one of the, right, so again, the stage that I most focus on is first checking the door. You might not have any traction. You might have some, right? There might be something clicking. When I say that we tell every one of our founders that we invest in, spend the first month or 2 just fully focused on customer discovery, I mean it. If a company comes back to me with something meaningful, that could be in the form of revenue, that could be in the form of engagement, that could be in the form of, I really have a good understanding of what the problem is in this industry that I want to go solve, and I can clearly articulate it, And I can clearly tell you that at 35K, ACV, that like we can go out and tackle this, and we've already gotten 2 pilots at 35K. Like if there's enough conviction behind a founder, like I'm definitely gonna take a second meeting. But it's hard to say like what the right meaningful, like what's meaningful to you as the founder, right? Like how do you know when something's different? It's a grind to get your first couple customers. It's a grind to get your first 100 customers. So what are you learning, and what can you tell us? Like invite us to your TED Talk and let us understand like what you've learned about the industry and your customer that can help us make a more informed decision. Because again, we don't know everything. Like you're the experts.
I know Serena and I have a similar background because in previous life, later stage investing, we had very specific ranges for revenue and retention in every single metric, and it was much easier in life when we could say, you have to hit this, sorry, your numbers are not that, therefore call us in 6 months. Now it's much more ephemeral. I think I'm more lenient on traction when Matt, you said personal interest. I know certain industries better than others, and I have a roster of people I can call. I focus on e-com enablement for my fund. And so it's much easier for me to say, oh, I know that's huge white space. I know all the competitors in this space. I can dig in really quickly on a deal just because I know the industry better. If I'm looking at prop tech, not your person. It's going to take a lot more to get me over the line and to help me understand, okay, this is what you're doing. It's different. So I would say that's probably a good question to ask in a first call with investors, is if they're focused in any one area at any given time or what they're personally interested in investing in, because sometimes that will give you a clue on whether or not we're going to dive in quickly and whether we might be more lenient on traction. But there's no good answer at this stage.
So true. This may be very infuriating to hear as well. This will be my last comment is sometimes it's really not you as the founder. I think that the reality is that when you come to pitch investors, you're competing against every other deal that they're simultaneously seeing in the pipeline. So your company, you may be building something amazing. I know that's happening at Kickstart right now. We had to say no to a deal this week that I felt so strongly that we should invest in this company. And most of the team felt that there was another company that looked just a little bit better. And that makes it so it's a no right now. And that's very frustrating. But just know that, just because, again, going back to Catherine's point, just because it was no with a certain investor, you have plenty of other shots. The venture capital market is actually quite large. I think we'll open up to Q&A. I saw your hand go up first, blue shirt.
Well, there was some discussion about crowded cap tables. Is there a path from equity crowdfunding to VC? And if not, are there other similar minefields to avoid and retain that option with VC money in the future?
We've seen this. I think so. The crowdfunding can be managed in a way that where it doesn't create an issue. I think, in fact, a lot of the platforms now it'll all go in under one like LLC, and so it's really a non-issue. In the past, though, it did create an issue when you had like 400 or 500 people on the cap table that could speak up and throw their hands up at any time. So I think a lot of the crowd. Don't quote me on this, but I think a lot of them have addressed this, and so it should not say, oh, no, we'll never raise venture now. I don't think that's the case, but be mindful of it.
Someone, when you're analyzing a deal or analyzing whether or not to continue investing in the company, I can be loud, but this is louder. So, how much does it ever, your thinking process of, with our resources, with our insight, this could work versus viewing a founder or, the company as a standalone, like, if it can't work in a vacuum without our resources, we're less interested? I don't know if that was a well-asked question or not, but.
I mean, we were actually just talking about a deal that we passed on in the venture fund, and they were selling to CISOs, like Chief Information Security Officers, and we just didn't feel like we had the biggest network possible to support them. we know B2B SaaS, we understood what the sales process was going to look like. We understood sort of okay, we feel like there is founder market fit for sure. We feel like there's probably product market fit given the logos that they had already. But there was just this moment where we were can we be kind of advisors? Yeah. There's a great podcast called Acquired. There's a phenomenal venture fund called Benchmark.
Favorite podcast.
It's such a good podcast. It's a 3-hour episode, but one of the biggest things that I took away from it is that they interviewed a bunch of founders that had been backed by Benchmark, and each one of them said that when Benchmark invests, one of those investors basically becomes a co-founder. And so kind of think about who you're going to put on your cap table from an investor perspective like that, because you want to make sure that they're going to be not just great advisors, but also big time value add.
Question here.
So having the right team is vitally important to a startup. Having the wrong team can kill a startup. The traditional routes of getting a fully loaded top-tier talent pool is pretty limited. You've got, recruiters, and then you've got LinkedIn right now. What participation, other than mentoring, and what kind of levers do VCs have in order to help startups get that top-tier team, get the right team built? Any feedback on that?
I can speak to this just from a personal enjoyment of the job. I feel like we work with the hardest working, most ambitious, biggest hustlers, just incredible human beings. You don't start a business from scratch and go pitch investors to hear no over and over and over again and pitch customers and try to figure all of this out on your own without being exceptional. So I just feel like we meet over the course of our careers incredible human beings all day long. And the longer that I've stayed in venture, I've built a network, and that's a lot of our job, is to network and get to know people and build 10, 15, 20, 25-year relationships, because there are people that I met when I first got started and was an analyst at a PE fund that I know were maybe a chief of staff or were leading sales at a high-growth company that are going to want to start their own company someday, or are going to want to go do that again and know the playbook and are very good at it. And so over time, my experience personally helping with talent function, some venture funds do have an entire talent function where they have recruiters on their team and help with that. My fund does not. Drive definitely does. My fund does not, but when I know that my founders are looking for team, I have a whole Rolodex of people over the course of my career. Some people might be in this room that are saying, oh, I've done this for my entire career. I'm exceptional at this, and I can partner them with folks that I meet and folks that I invest in. But that's probably my favorite part of the job, is every single person you meet is exceptional at something. Everyone in the room has a superpower. I don't know what it is, but if you can articulate it, we can probably work together.
Love it. I think we have time for one more question. We have one right in the front.
First of all, this was a great panel. Thank you, guys. I work with entrepreneurs and startups all the time with my job. I work for a software development agency, and I often wonder if their best foot forward is building a minimal viable product or designing a Figma clickable prototype. You guys talked a lot about the value of having a really great pitch deck and doing a good job telling a story. Do those other assets for a first check business move the needle for you guys? Do you find value in that?
I love good products. So, yeah, trust me, I noticed it. I think I mentioned the product earlier. It's just not a reason we usually would pass, but I certainly recognize this is a great product at the seed stage. And sometimes that gives you a leg up, right? You're further along. There's a lot of times what we found is some of our earliest investments, especially going after enterprise enterprise customers, they don't have a robust enough product yet. Customer X wants this, Y wants that. They don't have it yet. So the further along the product is, I think the better. As far as selling an investment, I don't know. Again, it's just not weighted quite as high not nearly as high as the team, at least for me. But it certainly does. Yeah, I notice it personally. It
probably goes back to the question about how much of this matters by stage, right? Where I think at late, past Series A becomes increasingly much greater of a weighting factor to Matt's point. And it kind of depends on what the product is too. So we have some companies that sell, let's say, into a construction company. That's going to be a really tricky product to vet because we're not a construction company, nor do we have that context. Juxtapose that with a company that sells into, VPs of sales or CROs. That's something that we can very easily vet within our own portfolio. And if our own portfolio leaders are saying this is a product that they would buy or that they love, it's really slick, et cetera, that reference, that weight becomes much more important, and that's something that we lean into. So depends on context, stage, as well as who do you sell to. Should we wrap it up there? Do we have time? Okay, good. Vic, go ahead. This is the last question.
Okay, I'll close it out. Okay. Hopefully it's not too long of an answer. So in a typical funding round, you may have a lead investor and then follow investors. So in going back to the point about managing a cap table and the relationships on that cap table, how should a founder approach an investor who maybe said no to being a lead investor but still wants to jump in as a follow investor in that single round?
Approach. What do you mean by approach?
By the way, Matt could probably take this because he syndicates quite a bit.
Yeah. So with our fund size, a lot of times we're not the lead. We would only lead something in the $1 to $1.5 million round. As you know, seed rounds are a lot bigger than that, quite a few times these days. So the way we operate isn't it on the investor side is like if you pitch us and we commit, we don't care if there's a lead yet at all. It can make it nice, but actually we like to be the first one to commit because you'll see the value we can add from helping you syndicate the rest of the round. And if you're not a lead, you're never guaranteed that allocation. And so most of the time we feel like if we're first to commit and help syndicate, like our allocation is going to be fairly safe or to an extent, like we'll get in the deal. So I think from a founder's perspective, I just, and I have some friends that do this as a fund. It doesn't usually work out well, but like if a fund tells you like, oh, come talk to me when you have a lead or has that kind of attitude about it, I don't really like that. You want funds that are committed to you, no matter kind of what that funding round looks like within reason. So
I'd follow up on that. So we lead rounds, and we've worked with Springtime a bunch of times. Springtime's unique in that y'all commit early. Usually, founders have to find the lead investor first. As a lead, I usually get on the phone with the other funds that are coming in around. At the point that a lead investor has come in, the founder usually has the choice to choose who else is going to come in, to Matt's point. And so I am getting on to talk to the funds, and usually I'll give feedback to the founder to say, I think they would be helpful. I think this would make the strongest syndicate. I think this would be a good match for what you're looking for, what help you want, et cetera. But
let's give a hand to the panelists.